Thank you very much. Yes, thank you, Kay. So this next session is very much focused on India and the stock market. Now, we actually changed, I don't know if anyone's been keeping an eye on the agenda over recent weeks. The name of the session actually changed from some very good feedback from the panel. So the current topic is a stock market recovery on the horizon? Now, clearly, the Indian stock market has been going through some problems in the last few months, but we're really going to spend this just over the next half hour or so to kind of get into the reasons why they came about, but really looking forward, is this a temporary blip, and where we go from here. So I've got some fantastic speakers joining me today. So on my left, we have Amrita Farmahan, who is CEO of Global Private Client at Ambit. Then we have Vikram Malhotra, who is co-founder and CEO of 361 Global. And then finally, we have Apurva Sahajwani, who is Managing Director and CEO of Avendus Wealth Management. So just starting, Amrita, with you, let's just review the last 5 months or so of the Indian stock market. What were the reasons for this correction that we've seen?
Great. Good afternoon and good to be here. So if you look at if we do a recap of the last 5-6 months when we've seen a correction in the market, I'd kind of like divide it into two parts. The first was from September end till about December, and then January to, recent. So the first part, I feel the market was looking for, on the back of like growth month on month for a long period of time, the capital market was looking for the trigger to it was a slowdown in the macro in August and some slowdown on the growth rate of earnings. And the market was looking for direction for 3-4 months, so it would go up, go down, but it was kind of range bound. And January to February and now, I think the market with the global events that got triggered, and any market that is in a bull phase and overvalues, then looks at the trigger could be anything, but then there's a sharp correction. So there's been a very sharp correction in the last few months. The Nifty is down 15%. The broader market is down anywhere between 23 to 30%. Stocks are down further. So the correction has been across market cap, across sectors, across quality, growth, value. There's just been no place to hide. Now, if you look at the reasons, one was the macro slowdown, which started. It was like a small shift. And the key reason was the monetary policy. If you look back, the monetary policy was slightly restrictive because the focus was on inflation and curbing inflation and not as much looking at growth. And with that, the fundamental issue was that the markets had run up and the valuations were quite expensive. And with the outlook looking like that the earnings would drop, the liquidity started moving out from some parts of the market. And in the last 12 months, we've seen a lot of liquidity move out from the FIs that have invested in India. They've been sellers throughout last year, and that got intensified in the September to December quarter. And just when it seemed like things were abating, the trade tariff war started, and that continued, the process continued. So I guess liquidity leaving the markets, valuations running ahead of themselves, and a slight slowdown in the macro as well as corporate earnings has got us to where we are. But the only thing, it would be remiss not to talk about the backdrop in which this has happened, because the backdrop is that 9-year continuous calendar year Nifty uptick. We've had positive returns for the last 9 years, and equity markets are not a one-way street, right? So this was about to happen. This had to happen. It was writing on the wall. The question was when it would and what would be the trigger. And for us, the trigger has been, in our opinion, global triggers.
Right. Yeah. That's an excellent overview. I don't know if either of the two of you have any thoughts on that analysis, any alternative viewpoints on that at all?
I think it was John Maynard Keynes who said that markets can remain irrational longer than you can remain solvent. So we've actually seen that level of irrationality in the markets. Sometimes that tends to happen on the upside, as we saw, like Amrita mentioned, over the last several years. And sometimes it tends to happen on the downside. So sometimes, you tend to see those excesses coming in. I think, but clearly the critical thing is where do we go from here?
Yeah, absolutely. Vikram?
Thanks for having me here. Just going back a bit when sort of we decided, and thank you for inviting me for this particular session. I mean, sort of was preparing for it a while ago. It was, I had my points, everything. And then I realized I had to literally change them every day because everything just kept changing. Like Amrita and Purva also mentioned, from September, we were, the India growth story remains intact. So in September, we had lots of irrational exuberance, and all of us were calling it to, I think, overblown caution today, in my view. But what that has reminded us is that when the wind is blowing, you've got to adjust your sails, and in some case you may need some lifeboats as well as things pan out. But I mean, I'm pretty much in agreement with both of them. I mean, they've actually laid it out. Amrita laid it out very well.
Okay, excellent. Well, look, let's look forward then. How? So we're seeing this as a correction. You talk about this sort of 9-year cycle. Where next? What has anything fundamentally changed, or is this now a real buying opportunity for the industry?
So at least the way we look at things, and from our perspective, it's very difficult to find any structural issues or any systemic issues, right? And we can talk about it. If we talk about the macro, right, India continues to be the second fastest growing economy in the world, right? And we are slated to grow between 6.2 to 6.5% is what the government put out the numbers right now. And if you look at the last 6 months, there's been a fair amount of activity that the government has done. So on our monetary policy, after 2 years, interest rates are coming off. We've had one rate cut. We're expecting 2 more. The market's expecting 2 more. If you look at the fiscal tax cuts, there's been more release to the consumer. There is talk about GST coming off. Again, more money in the hands of consumers. And there is now revival of the capex spend by the government. So in our estimate, these changes in monetary policy could add anywhere between 0.5 to 0.7 to GDP estimates and take us back to the 7%. At a 7% growth rate, India is today the 5th largest economy in the world. We are slated, looks like the probability of us getting to the 3rd largest by 2030 is visible, right? So the macro looks good. The second important consideration is that we have a very stable democracy and we do not have much risk on the political side. The government, of course, got a bit of a shock this time in the election, but they've come back in Delhi again, and so we have political stability. Our regulators are experienced, mindful, thoughtful, nothing crazy. So we are well regulated. So it seems like on the macro side, things are good. And if you look at India, the India story is essentially a demographic story, right? And nothing's changed there. Today, the average median age is 30, which is like in the middle of the productive cycle. And there's a fair amount of technology that is making things more productive. We have English-speaking, skilled, tech-savvy workforce on one hand, and we have at our per capita of $2,800, which is really low. The only silver lining is that we have the lowest, cheapest labor force in the world. So if you look at it from the demographics, like we have a lot of things happening on the public, private sides. Entrepreneurial culture is really building out. So if you look at from the demographic side, we think that is intact. You look at consumers, right? India is a market which has 300 to 400 million household consumers, which is extremely large. And we are essentially a domestic consumption story. 80% of our GDP is domestic. 20% is global. Of the 20%, only 30% is with the US. So even if you look at what is happening globally on the tariffs, we are not like directly impacted. Our impact is more second order, and hence we are not seeing that direct impact from that perspective either. So, if you look at all these factors, you look at the financialization of savings, that's been the big story in India, that Indian investors are now back into markets from FDs and bank deposits and real estate. They're now entering capital markets, and that number is so significant that it has sort of helped some of the fall because the domestic investor has been investing. But if you look at the number, right, it's still 6% of overall financial savings into markets. So we have a long tail, long runway, I should say, of money liquidity flowing in from the domestics. So if you look at all those things, it's, and the protection that we have, and of course there is risk in terms of, if the FIs continue to sell. But if you look at all the things that the government has done and the inherent strength in the Indian economy, I mean, it's just a question of time, right? Like when markets will revive and when they become attractive. And the most important thing, frankly, is that markets have fallen and valuations are now relatively cheaper. See, with the kind of growth that India has, or frankly, any company, it is not, you will always trade at a premium. So to get back to average 10-year, P multiples, or getting back to average since 2014 has not been possible. We have been expensive since we have started growing. So, but it's relatively cheaper. And if you look at all of these things, to us, like it seems, it's just a question of when the markets will go up and recover.
Yeah.
Yeah.
So very much a buying opportunity, it seems to be, for if you're a longer term investor with a longer term horizon.
Absolutely, because see, you just don't know when, because right now I think that a lot of the turbulence in the market is being caused by what's happening globally, and nobody knows what's going to happen next. It is just too much happening every day. And in a market where FIs are still 17-18% of our market, they've exited $35 billion, which for Indian markets is a large number. So there is turbulence. So as long as, and there is, nobody can call the top, no bell rings at the top or the bottom, right? So you have to, if you are a long-term investor, I think in our opinion, there is an opportunity right now, which is a multi-decade opportunity of not just investing in the Indian capital markets, but even in India across multiple sectors.
And just being able to ride out any short-term noise. It'd be great to get your thoughts on.
So actually Amrita really put it really very nicely. I mean, covered virtually every aspect of it. So I think fundamentally, it's a great story. Third largest economy in the world in the next 5 years, all going well. I think you can't, you can't not be there. You can't miss it. Valuations much lower than they were just a few months ago. She touched on demographics, average median age of 30, 900 million plus sort of working population. I think a lot of initiative by the government in terms of Make in India. This was a policy initiative started several years ago when the government came in the first time. And the idea is to make India as self-sufficient as possible. And with the supply chain sort of issues that are happening elsewhere, we tend to gain at the China plus one story. So in fact, if I'm not wrong, the second largest mobile phone manufacturer globally. So I think all of this is sort of coming in. We've had recent regulatory changes at the top, at RBI and SEBI, the two top institutions, both again coming in strongly, making statements to support sort of India growth. The fiscal side, current account deficit is very sort of healthy. So everything sort of moves in a very manageable way. The tax cut will lead to more sort of consumption. Yes, what happens in the slowdown is that's investor behavior. So, the money going into markets, the systematic investment plans, etc., all that is seeing sort of a slowdown, from what was going into mutual funds on a month-on-month basis, that is slowing. So it's very difficult always to sort of, time the top or the bottom. But fundamentally, I think the story is extremely strong. We're seeing activity in the alternate markets that continues unabated. So Temasek just bought 10% of a large Indian sort of company in the private market. All these activities are happening virtually daily. So again, because they see a slightly longer time horizon. So we all sort of aligned in terms of the fundamental story, the macros, and corporate earnings have also sort of improved. The previous quarters behind us, 6.2% growth expected. I think it's a no-brainer.
Apurva, it's good.
No, I'll just add maybe a couple of points here. See, it's important to look at the past, not to extrapolate it to the future, but to try and get a sense in terms of what is the direction that Indian markets have seen. So if you go back 30 years, you'll see that nominal GDP in India has grown at 12.5% annualized, right? Interestingly, if you see corporate earnings in India, they've grown at 12.5% per annum. And our bellwether index, which is the Nifty index, will complete 30 years in November this year. Incidentally, that's also grown at 11.9%, close to that number. But if you add back the dividends that those 50 companies would have paid, which comprise the index, that will take that number to slightly higher than 12.5%. I think it's phenomenal, if you ask me, for a country to deliver consistent 12.5% growth over a 3-decade period of time. It's commendable. Interestingly, if you look at the last 20 years, right, just cutting short that period of 3 decades to 2 now, and if you look at the Indian market's performance in dollar terms, the Indian markets have delivered 10.4% annualized, much higher than any other emerging market. Interestingly, that matches the US S&P 500 performance, which means over a 20-year period, you have an economy which has kind of kept pace with what the S&P 500 has done. So India has been a market which has always rewarded patient capital. The challenge is, in the short term, you will have volatility. We are obviously extremely linked to the global economy. We are oil importers, net oil importers in a very big way. So whatever happens to oil has a very large impact on the economy, on the macros. But I think we are now getting into a phase where a lot of those negatives seem to be priced in. I think oil seems to be well in check. Of course, we've had a currency impact. We saw the rupee weaken from 84 to 88 to the dollar. But as Amrita mentioned, we've seen phenomenal outflows. Interestingly, if you also look at the extent to which overseas investors own stock in India, today that number is converging with what Indian investors own in terms of stocks. That number is almost down identical to the second decimal. So I think it's now a lot of, as the sands have shifted, a fair bit of stability is emerging now. And I think that's giving a lot of cues to long-term investors to start coming back into India.
So when were you expecting the investors to turn? So presumably this is what you're talking to clients about, but when are you expecting the tide to turn?
See, valuations are now practically at the long period averages. There is one caveat I must mention. See, as a house, we look at a proprietary model. You know, we've created a score. That score is on a scale of 0 to 10. In September of last year, we were at 9.6, which on a scale of 10 showed that we were extremely overvalued. I mean, way into the overvalued territory. That number has actually come down to 6.8, right, in a matter of 5 months. So it's making us very optimistic. But the caveat is that the broader market in India is still not properly valued. So the moment you go outside of the large cap, which is the top 100 companies, there is still some froth visible. So the mid cap, which is the next 150 stocks, or the small cap, which is everything thereafter, is still trading at a fair bit of premium to historic valuations. If I remember my numbers correctly, I think mid cap historically is traded at about 23 times. We are at 27 times. Small cap has traded 16 times. We are still at 20 times. So there is some bit of froth in the larger market. We think instances like these are an opportunity for consolidation. So it's a great time to buy into strong businesses which have great fundamentals, which have earnings visibility, which today we think will be in a position to tide over whatever challenges come their way with trade wars and all of that. So I think Morgan Stanley called it the other day. They called India a stock pickers market. It actually, I think, is indeed a stock pickers market. So these are bellwether indices numbers that I've discussed with you. But if you look at some of these components, some of the components of these indices, and some of these companies have been around for those 30 or 20 years, the returns that they've been able to generate for investors have been far higher than these 12.5% rupee and 10.5% dollar returns.
Okay, interesting.
Yeah.
It'd be great to get your thoughts on when you think investors are going to start coming back.
Conversations actually, I could talk about out in, and I think, and that's what Apurva and I were just discussing before we came in. I think people are just waiting, when to sort of, what is invested remains invested. Nobody's really, at least for longer term, sort of cut because it's not leveraged or, that's been good. But investors, I think on the large caps are all ready to sort of come in and are, slowly coming in already. So the problem is anything geopolitical that happens every night and then the next morning sort of gives a, so that's the only, point of caution, that would that have an effect on India. But like all of us are sort of aligned in our view that, India needs to be looked at from another perspective of how strong it is, sort of the macro is or domestically. Interest to come in, and that continues. Actually, some people are happier because the correction has happened before they've come in or while they've been sort of contemplating. On our asset management side also, I think interest of sort of mandates is excellent. So I think it's just a matter of, now more than anything else, and sooner rather than later.
Yeah.
In my opinion, the domestics are staying. So if you look at domestic capital in the markets, that's only growing. And while there's a lot of headline around SIP numbers coming off, but the value of the investments of the Indian retail investors are not coming off. And they are on an amazing trajectory. So that capital stays. Now the question is when the FIs come out, and if you look at the F&O positioning of FIs in India, they're currently fairly short. I think they are going to wait for some of this volatility globally to subside, get some direction on how this will pan out in the US, and then look at coming to India. Also, our monetary policy impact, I feel, is going to take a couple of quarters for earnings to come up, and the markets will be a little ahead of the earnings. So in our view, earnings will start looking better from a growth perspective in Q2 of this financial year, and we think that investors, FIs will start coming in, hopefully before that.
Okay.
Yeah.
Very good. I think you've all mentioned it at one stage or other, the impact of checking your phone in the morning and seeing what Mr. Trump has written on social media overnight, changing policy, new tariffs coming in, counter tariffs. What does that mean for India and specifically the Indian stock market? I mean, it's very hard to work all this out. You mentioned it's more of a sort of second order at the minute. But how can you, if you can at all, navigate that as a kind of phenomenon when you're thinking about investing in Indian stocks?
So actually, if you just look at the numbers, they tell the story themselves. So India's share of US imports is between 2 to 3%. So it's not significant. We are not top of the line to have the conversations around tariff hikes or cuts. Second is India is 80% domestic, 20% global, and US is 30% of that. So we are not an economy where there is too much. We are a domestic story. So there's no direct, there's very little direct impact. And of course, the government is in such situations, clearly, they've taken a reconciliatory note. And I'm sure they will bring tariffs down, to just make sure that the friendship that is being built between US and India continues. And it is helpful that our Prime Minister and Mr. Trump share a good relationship as well. So for us, I don't think there is going to be much direct impact. The numbers are just not indicating that. However, I think the second order impact, which is when will the FIs return to India, are going to determine markets. And as Apurva mentioned and Vikram mentioned, there's a lot of interest outside of the capital markets as well. We get a lot of flows in the unlisted markets. That continues. In fact, today I think the Blackstone CEO was in India, and they were talking about how India has delivered the best returns on infrastructure and private credit for them, and they're committing billions of dollars more into the country. So for the way we are looking at it is that this is the story. I think at some level, people will sort of get tired of looking at the papers every morning and reacting to every little change. There's this thing that will continue for some time, and the markets will sort of get used to it and move on. So we are not seeing too much of impact except how the flows will work and how soon will the money come back in.
Okay, interesting. Something, a view you share?
We're all waiting to see what happens on 2nd of April. But as far as the whole tariff narrative is concerned, I think the bark seems to be worse than the bite. In all likelihood, I think you will start seeing negotiations. The fact of the matter is that, for us, we have two very large trading partners. There is China and there is US. Interestingly, the trade numbers are identical, about $130 billion each. The difference is that we are net importers from China, we are net exporters to the US. I think, like Amrita said, we're actually not very significant in the overall scheme of things, but it is also a big market for both China and the US, especially for value-added products and services. So in that sense, I think better sense should prevail, and we don't think this will have too big a bearing in as far as India is concerned. I think there are larger ramifications between what happens with the US and Canada and the US and China. I don't think this will have too much of a bearing in terms of the way equity markets in particular behave going forward.
No, I agree with them. So, and I think we manage the relationship well. The government manages it across, with various sort of touch points in terms of visits. So, and of course, we will, India will cut some tariffs, etc. You have to sort of, in US and China, the largest trading partners. In fact, China is slightly larger. I think now. Work with them to sort of, manage this smoothly, and at the same time, actually tying up with other countries bilaterally. So FTA with UK, for example. So I think, other channels will always open. So where you could have a lot of other sort of direct activity happening, which in the longer run will only benefit us, benefit India.
And that relationship with China, I mean, how do you see that being affected, if at all?
See, it's cooperative and competitive. It always sort of has been. We had sort of positive dialogue in terms of, on the government side after a bit of a, icing of relations a few years ago. That ice broke, and I think that's been positive. And what happens is, again, I think, both are too big to sort of not work with each other. And our largest trading partner, equally, India is sort of a big export market for China. So I think it's a relationship with dialogue. I think things will sort of only improve. And the way the world is sort of playing out, you have to build your bilaterals. I think, it's reached a stage where you will always have your deal with everybody individually, more than anything else. And that this gives us an opportunity to, fix the other political aspects also that have sort of, been pending for a while. So I actually see it positively.
Yeah.
No, I agree with Vikram that we are in a multipolar world now. And I think as far as China is concerned, go back 5 years, we had very strained relations because it came out of a phase of intense border skirmishes between the two countries. But if you look at, I think the last few months, there is a thaw in the relationship. Both countries acknowledge that, they're active markets for each other. See, for us, we're a services powerhouse. And we're building our manufacturing capabilities. It's interesting, there's a narrative which says that India actually leapfrogged one entire generation. From agriculture, we moved directly into services. So we didn't really have a very large manufacturing base. I think a lot of that is happening now. So we've seen some initiatives which the government has taken, the performance-linked incentive scheme, for instance. So I think it's also turning out to be a big market for people to look at, in addition to, as far as diversifying their exposure to China is concerned. At the same time, the China, set of products and services also have a very strong market here in India. So I think what we're likely to see is, this truce continuing. We're likely to see, some kind of an equilibrium which will emerge. And that to us is good news.
I read something interesting about how the elephant and the dragon are natural partners.
Right.
So I think that, we import a lot from China. I'm redoing my house and my furniture is coming from there. So we are a big market from, they're one of our largest, as Vikram mentioned, trading partners. We've had a complex relationship with China in the past, but both the governments clearly seem to be making the effort to find common ground. And I know in this part of the world and many parts of the world, it's either a China trade or an India trade. I'm not so sure that is how it works, because if you think of it, the MSCI emerging index has 30% China, 15-17% India, and if both countries do well, there is larger allocation into emerging markets and both benefit. So I think it's a very interesting partnership that should play out.
Okay, excellent. I want to make sure there's time for questions from the audience. So if you have any, please raise your hand now. There are 2 questions. You were just the quickest by about half a second. So there and then there afterwards. Thank you.
Thank you. There have been a lot of talks about AI chips with regards to Taiwan, US, China. What do you see the potential for chips AI in India, and what are the challenges?
Yeah, very good question. Anyone like to take that one?
No, I think, we, like I told you, we are kind of focusing on manufacturing extensively now. And today, if you see the kind of capabilities that we've built, they're particularly strong. But I think in as far as the R&D is concerned, admittedly, we're probably not there in terms of what we are seeing coming out of, let's say, what China's done with DeepSeek, for instance, or what we saw coming out of the US. I think for us, we are very early adapters. And that's something which has always been a big advantage. So, I think we'll remain a big market, and as far as AI is concerned. On the manufacturing side, to my mind, once those capabilities are developed, once, I think the prototypes are at a fairly advanced stage, you will see that essentially that scale-up will come in. We've got some great companies in India. Some of them are listed on the exchanges. That's given an opportunity for for investors to come in and kind of play the trade on manufacturing. But as far as AI is concerned, I think we are still a little bit on the fence in as far as manufacturing capabilities go.
Yeah, I would kind of agree that, if we were to be honest, I think, US and China on AI have moved very far ahead. And while we had a very robust technology sector and platform, right, in terms of just the basic R&D on developing and manufacturing chips, I think that ship may have already sailed, and we will do what it takes from a manufacturing perspective to get back into it. But on the usage side, right, like I think we have a thriving economy, a lot of consumer companies, and it's kind of interesting when you anecdotally look at how the small consumer companies are using AI to connect with clients. So I think the opportunity really for us from an AI perspective is on how we can bring in more efficiency in how we run businesses and more efficiency in how we run productivity for people.
Just a quick question on that. Any thought on impact on jobs, the AI? I mean, you mentioned sort of the big servicing side of the economy. Is that going to be impacted at all?
There are obviously certain sectors that will get impacted, and they're really on the top end, high skilled areas. But at the moment, I think that the influence of AI into the corporate sector will take its own time, because for India, right, like as I said, at 2,800 capita per person, that is a very, that number needs to extend quite a lot. So I think creating jobs and having people employed and having the youth employed, I think is like a very, very critical initiative and focus area of the government. So I'm not sure that jobs will be allowed to be taken away. And we will have to balance being competitive versus the requirements of finding employment for our youth.
Actually, if I may add to that, so Amrita rightly said, it's the productivity which actually sort of improves, and there's a lot of sort of adoption in the small companies. But what India does well is now the states also come in. So say we have a central government and then we have a government at the state level. The state governments actually are now going in to pitch with investors to attract them to their states. Normally Maharashtra, which Bombay is the capital of, has been a big recipient. But now there was a lovely article in Straits Times about 2-3 weeks ago how the Northeast is sort of positioning themselves in terms of attracting big investors to come in there instead. And sort of this is really coming in broad-based now. And I think that will also help in terms of job creation. That was one of the issues that cost the government loss of some seats in the election, apparently. So I think, that's not going to be compromised.
Right. Understood. Second question here. Yeah, thank you.
Thank you. You were presenting the case for India very eloquently from both a macro and also a micro perspective, and mentioned Blackstone is praising the market to be so good for them when it comes to returns in infrastructure. In particular, my question pertains to that. As a foreign investor, navigating governance topics and corruption topics in India is sometimes very challenging. Canadian pension funds just got caught up in the Adani corruption situation on the green energy side. How would you propose for foreign investors to navigate effectively the governance topic and to prevent corruption issues and governance issues to impact the investment story for the Indian market?
Okay, so an interesting question to round off on. We don't have an awful lot of time. I don't know if anyone wants to take that on, or each of you have a very short thought.
I can do a quick one.
Okay.
I think we've made a lot of progress in where we were maybe at the time this government came in 2014, and I know that it continues to be, as we speak to colleagues who work for FIs who are investing in India, it continues to be a challenge for them to navigate getting approvals. But you just look at the infrastructure spend that is coming into India, and that is coming from some of the largest global players, and that is going directly to the heart of India. And so if we want the money, the government will have to make it easier. Frankly, it's as simple as that. And if the world sees the opportunity in India, then the money will flow in. But yes, there's a lot of work to be done. It is way better than it used to be, and there are improvements, and that improvement has to continue for us to attract capital.
So we're not there, if I may add, where we want to be, but the direction is clear. Whether it's ease of doing business index or corruption index, you see how much India has sort of leapfrogged in the last 5 to 10 years. But are we where we want to be? I agree, no. But much, much better than before, and I think directionally, really, just a matter of time where we land up where we should be.
May I just close with an example here?
Yeah.
In the interest of time, I'll just make it very brief. We have more than 6,500 listed companies in India. It's a massive market. Historically, we've had instances where, issues like these have become full-fledged contagions. But day before yesterday, a large private sector bank in India reported, a derivative loss, a very large derivative loss, which the jury is still out in terms of, what exactly happened. In any other instance, the entire banking sector would have seen a huge impact. But that very day, other banks actually ended up positive. So the point I'm trying to make is that, in a very large market like these, I think, unlike what we've seen in the past, instances like these are largely confined to 1 or 2 cases. I don't think we should look at extrapolating them to the larger market.
Okay. Thank you very much. We have gone over time, but I thought it was a very interesting question to end on. We have networking drinks outside, then back here for a session on digital assets and the final 2 or 3 sessions of the day. But before then, thank you very much to my panel.
Thank you, Evan.
Thank
Nice
you.
being here.
Thank you.
Thank you.